right. Hey, everybody. Welcome to the Ultra High Net Worth Clients Podcast. I'm your host, Chris Broadhead. Today, we have the pleasure of talking to Elie Nour. Elie, can you introduce yourself and tell us a little bit about you?
Perfect. I'm glad to be here, Chris. Thank you for the invite. Like you mentioned, my name is Elie Nour. I'm a CEO and founder of Nour Private Wealth. I wear two hats in the company. I'm not only CEO, but I also a portfolio manager. So I have my client base, which I've been taking care of for many years. One is my passion. The other one, I have to do it. So I would imagine managing money and taking care of people is my passion. And that's where we are. I joined the industry almost 19 years ago, worked for a boutique firm, which eventually got sold to a big publicly traded company. And as the years went by, I always wanted more and give clients more and improve my the value added that I can bring to the table. Finally, I decided to launch my own firm. The company was created or founded almost a bit more than 10 years ago. But we launched a securities firm around 5 years ago, a bit more than 5 years ago. And so here we are.
Mm-hmm. Awesome. We'll definitely be touching on a lot of that incredible story. I do like to start at the beginning. Elie, how did you get involved in this wild industry?
You know what? I believe I always had an interest with when it comes to the investment world. Numbers where I always found them fascinating. They just simply made sense. And so, growing up watching movies, I realized that my personality fits somebody who's serious, wearing a suit, going to work and working with numbers. And I couldn't have picked a better professional life than the one that I'm in. And so I joined the business. I applied, like most people, I was attracted by big names, large financial institution. But the one that I was able to connect the most was the firm that I ended up joining many years ago, called Berkshire Securities. And even though it didn't offer what others did from, let's say, scale and name, but I always liked the independent space, because I always saw that I don't want to feel like I'm pushing anybody's agenda. I want to be able to give clients fully independent advice. And so that's how things started.
Mm-hmm. Awesome. So you were working for a Berkshire company. Was
Correct.
Warren Buffett ever an inspiration to you?
Actually, that's a great question. So Berkshire Securities, or Berkshire Group of Companies, was owned by Michael Lee, who was the largest Canadian shareholder in Berkshire Hathaway. I have a lot of respect for Michael. I'm good friends with him. And because I've worked hard from day one, I got a chance to fly with him to Omaha, Nebraska back in 2007. And I met in person Warren Buffett, Bill Gates, one of the Tata brothers. And you know what? A lot of things I've learned a lot from being there. First of all, it was like a kid on Christmas, because I couldn't imagine 2 years after graduating to be in that environment, meeting the wealthiest people on the planet. But what I realized, one thing was quite common, is a lot of people are wealthy, a lot of people are smart, but most importantly, they were extremely modest. And that's something that was quite inspiring or eye-opening for me. Other than that, so that's 2007. Berkshire was sitting probably around 70% in cash. So Warren Buffett was sitting, want to call it Berkshire / Warren Buffett, sitting roughly at 70% cash. So what has helped me in 2008 is basically, I've read his books. I've read Benjamin Graham, so his mentor, Security Analysis and The Intelligent Investor, and so on. And I did well by protecting clients from the downturn and the great financial crisis in 2008 by having a higher level of safety. And I've done things right. I'm going to say 50% has to do with knowledge, but the other 50% has to do with luck, in the sense that I was lucky to be able to travel to Omaha, Nebraska. I was lucky to be exposed to these people. I was lucky to be in the right place at the right time, learning from the best people out there. So luck
Wow.
has to do with many things. Yeah, yeah.
Yeah.
And then I
That's
just
it.
capitalized on it as the years went by.
Yeah. That's incredible. So you said you met them in 2007, right?
Yes,
Okay,
2007.
so not only did you get to meet some of the most incredible minds in this industry and the world at large, but you met them before one of the, most cataclysmic market events of all time. What did they how did they justify? You said there was 70% cash in
Yeah.
2007? What was their justification?
If there's nothing of great value to buy, then you just sit on the sidelines. Like when you're buying companies, so his philosophy is always to buy companies that are trading below their intrinsic value, or call it the fair value. So you don't want to pay like 80 times earnings, 100 times earnings of a company, 200. Now we're seeing it with the AI excitement that we've seen this year, companies trading at 300, 400 times earnings. You want to buy stable companies. I like to call them the plain board vanilla ice cream companies that offer a good or a service. I don't buy anything that I don't understand. Let's start with that. So I want to buy companies that I understand what they do. I understand how they generate their revenue. And I want to get, you know, I want to get them at a good price, at a discount. And quality is never cheap. Quality every now and then you can get at a discount. So think of any real estate anywhere across the world in major cities. You can never get a property extremely cheap, but every now and then, due to maybe events, recession, COVID, you can get, like, say, nice property in New York down by 20 or 30%, or Paris, or whatever it is. So quality is always appreciate the most over time. You're almost always paying a premium, but every now and then, if you can get it at a discount, just jump on it. And if you buy quality that drops in value for whatever, market conditions, just buy more.
Mhm.
If you don't do that, then the decision of you buying in the first place was the wrong decision. That's basically.
Mhm.
Yeah.
Awesome. Awesome. So it sounds like you cut your teeth on, the previous biggest recession we've had in a long time.
Mhm.
What are you seeing now, and how are you feeling about the market?
That's a great question. I'm seeing a lot of similarities today that I've seen in 2007. Okay. And especially when it comes to yields. So I'm excited about the least exciting sector, or not sector, but asset class, which is government bonds. So today, believe it or not, I swear, like there's something called an equity risk premium. Um, Today it's at the lowest since 2000 and 2002. But so today I see people running and excited about GICs that the banks are offering at 4 and 5%. Government bonds today, they're offering a coupon of 4.8%. And we would expect, and they're trading at a discount. So historically speaking, every 1% cut in interest rates is reflected as a 7% capital appreciation government bonds. And retail market today is expecting 6 rate cuts next year, institutional 4. Now that's the base case. Whether it's 4, 6, or 8, it doesn't matter. Cuts will take place next year. And generally speaking, 6 months prior to the first cut, bond market starts rallying. So if we're expecting a minimum of 1% cut, so 4 cuts of 25 basis points, that's 7 plus 4.8, you're low double digits in bonds. So why take the risk? Right. So it's not, you need to be compensated if you're taking a higher risk. Today, it's simply not worth it. I'm not saying there's not money to be made on equities. You just have to be a lot more selective. So you have to adjust for companies that do well in a recessionary environment, like healthcare, for example. Okay. So companies that have high free cash flow, high dividends, sustainable dividends, because you need the dividends that are paid are sustained by the free cash flow. You don't want a company that's paying 12%, but they have, 4% free cash flow. Or else they're going to have to cut it. They have no choice but to cut it. Algonquin Power would be an example. I don't want to give names, but that would be a good example, that they had to cut their dividends early this year. So low multiples, low beta, low PE, high dividends, and, price to book that's reasonable, and so on. So Look, it's really math. It's like the economic cycle. It's pretty straightforward. It moves in the same direction. Like it's always, you need to know the history in order to manage money going forward, understand what cycle we're in, and just, do what you have to do, manage money properly. So I'm more cautious. In short, I'm more cautious today than I've been since for some time now. So I'm higher in safety. I'm higher in bonds, in every portfolio model, because our models go like, we have 6 main mandates, I'm going to call them. 100% equity all the way to 100% fixed income. So 100% equity, then 20, 80, 40, 60, 60, 40, 80, 20, 100%. So no matter what the allocation on the cash side, where we have a higher position in cash than we've had, in the rest of the balance mandates, we're higher than the long-term target. So instead of being, let's say, on the 20% bonds, 80% equity, we're close to 35% in bonds, plus we have some cash. And even the bonds, they're in mainly government bonds, 100% in government bonds today, 100%. Now, 2007, when the market starts slowing down or start selling off, like 30-year government bonds were up by more than 10%. 2008 market crashed. They were up by more than 41%, believe it or not. So there's money to be made on bonds. Now, I'm not saying what's going to happen is 2008. I still believe this is a man-made recession, right? It had to do with rates going up. Rates went up because they printed money as if it's going out of style. They printed money, cut interest rates, and did all what they had to do because of COVID. I mean, we've never seen, government shutting down our borders ever before. But I think they've done a phenomenal job. I'm going to talk about Canadian government. Let's just say, stick to Canada. The government's done a great job. They overdid it a bit with the CERB being pumped, deferred the payments twice. And then they hit the brakes, and we've seen the fastest rate hikes in the shortest period of time in more than 40 years. So yeah, it's an exaggeration. Going from A to B, stepping on the gas pedal to the maximum, and then hitting the brakes a few minutes before, it caused real assets like real estate, caused, bonds, stocks, everything to correct last year. So we've had a bad year last year.
Yeah.
No drama. Like you need to understand and know how to navigate it, because money can be made no matter what market conditions take place.
Mm-hmm. Got it. So do you think, it sounds like you touched on it a bit, but are we currently in the recession? Is the recession coming? Are we on the tail end of it? Where are we from your perspective?
That's a great question. Look, so we've been hearing a lot about the soft landing, hard landing, or recession. These have been the main 3 topics. So is it going to be soft landing? That's what you hear the politicians and, Federal Reserve, Bank of Canada saying, okay, we're expecting a soft landing. We believe it's going to be hard landing, but we've invested as if we're heading towards a recession. So, speed limit is 100. We're going, I'm going to say 50 with 2 seatbelts right now. Okay? It's not an exaggeration. It just because the bond environment offers so much value that it's not worth it. Unless I have the potential of making more than 30% on stocks. Like if we take the composition of our equity portfolio, let's take the Canadian today, our target return is roughly 35, 36% on these positions that we're holding, plus another 4.8% dividend. So that's a 40% upside today with the beta of half. So we expect half of the volatility of the market, high free cash flow, high reasonable dividend, low PE, but at the same time, when it comes to stocks, when the market drops, even the best companies will drop in value. Now, and we have a high position in cash. Bonds. So if I asked you, Chris, today, would you rather have 50% probability of making 25%, 25 to 30%, or 99% probability of making 15%? Are you willing to take that 50-50? So 50% you might lose or make 25%, or you have a 99% chance of making 15%. Which one would you choose?
Yeah, 99.
And that's why we're heavily tilted towards fixed income today, because the probability is extremely high. So if the institutional investors are expecting a rate cut in the US second half of next year, call it June, July, then usually bond market should start picking up in anticipation that the rate cuts will take place at least 6 months. So as early as say the end of next month or December, we should start seeing bonds start picking up. Last year was the worst year for bonds, worst in 242 years. And it
Yeah.
was the second year of negative returns. Second year. So imagine you buy bonds for capital preservation, income, and lower volatility. For the past 3 years, you haven't seen any of these 3 points.
Yeah.
I'm going to add point number 4, that we use them as a tool to take advantage of major drops in the equity markets. So now we're heading towards a potential, pullback 5, 10, 15%. Can happen for any reason. Just sentiment can change. So we'll see. We'll see. Volatility is good when you're managing equity.
Are you holding any cash?
No. Well, I'm holding cash. We're quite tactical in what we do on the bonds and on the stocks. So going back, if the mandate is 100% equity, 100% in equity, so we have equity in US dollars and equity in Canadian dollars. The US dollar, we're sitting at 45% in cash. The Canadian mandate is sitting at 35% cash. We've made a lot more money on the US equities this year naturally than we made on the Canadian. So Canadian probably were up by roughly 11 to 12%. US is close to 19. And that's not because we got lucky. We bought NVIDIA or Meta, and it wasn't this. Our decisions are not based on one investment. Like not one investment makes a difference by itself. So we actually prematurely sold Meta and NVIDIA, but it was still good 70 and 80% upside. And the rest is profit taking. Like we took out General Dynamics with, unfortunately, what's happening in the Middle East today. We sold a stock, General Dynamics, that we had it. We bought it for a good deal, or at a good deal, but we sold it. It was up last week on Monday by 8.5%, second day by a bit. So we were happy, 15% in less than 2 months. We took out profits. We build it based on small wins. Like there are no home runs in what we do.
Yeah. Just base hits.
Yeah, look, I say it's in buying requires knowledge, and there's no lack of knowledge. There are a lot of advisors that are quite smart. There's tons of information out there. Selling requires discipline. That's where most people fail. Buying nature, and our nature as money manager and investment advisor and wealth advisor and so on, we have to be optimistic. We feel like, yes, markets always perform better over time. So naturally, we know if you hold on, you're going to do well. Don't try to time it. But every now and then, what we've done, the value that we've created today, especially this year, is by taking profits at a faster pace than usual and buy back the same companies at a better deal. So no, you need to know when something is expensive. That's the bottom line. Yes, like Apple is great, but I don't want to pay $195 buy into Apple. 126, nobody wanted to buy it. 183, we took the position out. And I got few calls when the stock went up to 195, 196. Elie, you know what? It's a great company. Yeah, it is a great company, but a great company doesn't make it a great investment. So it was expensive. I'd rather reallocate the funds to something else that's discounted. The stock now is down to 170 something. So it's not like I reinvented the wheel. It's just something's more expensive, and that's it, right? So
yeah. Wow, that's awesome. I love it. I could just keep asking you questions about the market at large for the rest of the afternoon, but I want to talk about some purely financial advisory, business growing stuff. So, you have built an incredible business, and you've done it in a fairly small amount of time, relatively. How did you do that? How did you come out of school and just fast track this business to such a tremendous level of success?
Success is quite relative, right? I mean, I've done well, but I don't look at it that way. I mean, when you start any business, especially like I've chosen Berkshire where there was no base. Right? So if I don't bring business in, I'm not going to be able to pay my rent. So I cut down all expenses down to the basics, and I've taken there's a lot of stories like this. So I've taken 3 buses and the subway to get to the office when I started. There's no drama. I mean, these are the things that I had to do, and I had already cut myself off from my family, like support. Not that they didn't offer. I've chosen. It wasn't what I was lucky to come from a family that, we didn't miss out on anything. It's like a good, same middle class family that gave us everything we needed. So we didn't know that we were missing anything. But when I moved to Canada, it was, so I came as an international student. After a year, I realized that if I'm not working, I'm different than my friends. So I ended up actually starting to work because all my friends were working, and
Mhm.
nothing. It was the jobs that were fancy. I worked at a convenience store, so it's 650 an hour, and that's basically it. So, but it helped cover the bills and so on. So when I joined the industry, I just wanted to do well. I wanted to succeed. I wanted, you know, I had like 2 suits, I don't know, and like a couple of shirts, and that was it. So I built it from day one. And at first, I started looking at all the things that other people had, in the sense that when we're insecure, when we're young, we start looking at our disadvantages rather than our advantages, right? So I didn't have, I'm Lebanese, so I speak Arabic. I have an accent in Arabic today. I have an accent in French, in English, and Spanish as well, because I had a minor in Hispanic studies. So I've always felt like, okay, like I go in and I remember these guys. There's a guy sitting next to me. His name is Kurt Owen, Australian. Another guy from the West Island, Montreal, what's his name? James Davidson. And then another guy, Jonathan Showers, who was pretending to be British, but he wasn't, like working with his accent. But the bottom line is, these guys, I come in and like I graduated from McGill. My friends had either no money or had student loans. Nobody had money. What am I going to solicit? And my family's back home in Lebanon. So I built it by taking the yellow and the white pages. Remember these big books? And I used to highlight, these are people that I'm reaching out to somebody, and take my list with me home. So that's how I built it. And I started realizing that when people see you put the effort at communicating, put the effort, like you're persistent, that you have something to offer, and something you're quite convinced, they'll give you the time of the day. And I didn't know a lot. I didn't know much other than, like, 1 + 1 = 2. That's the extent of my knowledge in wealth management. I was just eager to learn from every single person. So I just shadowed everyone. And before I knew it, my commitment to work, the time that I've spent at the office, I was one of the first ones to get to the office, even though I had to take 3 buses and the subway. The last
Oh,
one to
wow.
leave. Yeah, the first paycheck, I got like a purple Mazda Protege 5. Like, that's the first paycheck that I got. It was at least take over. I was happy it had cruise control. I felt like I just bought. It was the first car that I drive. That's my own. That I bought it. So imagine
Yeah.
how happy I was. But I get that day, and then my boss back then had bought just a Lamborghini in Murcielago with the doors that open up. So I went and hit it. I hid my car in the next parking lot. Even though I was proud of it, I was like, you know, what they say. So I ended up hiding it. And after a week or two, colleagues started realizing that I actually had a car. So, like, I built it, and I wouldn't change a thing, because a lot of people say, well,
Mhm.
I had it tough, but no one can create value or become great at anything unless you go through some challenges. That's what allows you to grow. And at first, I started targeting people that with me that started in the same training class as I did, and I wanted to beat them, even though I was the last one to sign an account. And just because, not because of lack of effort, it just sometimes, things take time, especially in this business, like buying good investment. It takes time. You can't say, I want to buy it and immediately start making money. And then I started targeting people that started 6 months before me, and a year, and so on, until before I knew it, I became my own benchmark. So I want to say, okay, you know what? Now I want to bring $1 million a month of business, then 2 million, then 2.5. Then just things took off. And I stopped thinking about what I have to bring in. And I just want to help as many people as possible. So it stops becoming about the money. First, you want to survive. Then it becomes, you want nicer things. Then, okay, you've done it. Then what? And so now, as you know, I'm where I am today in Winnipeg, trying to focus as much of my effort to reach out or create value to as many people as possible. And so we'll get to that.
Mhm.
Back to you, Chris.
Awesome. That's awesome. So, as you were building your business, did you focus on a certain type of client? Did you go, "Oh, I can serve this type of client"? Did you niche down? How did you identify who your ideal client would be?
Honestly, I didn't because I couldn't. If you had $5,000 when I started the business, I would have taken it. I couldn't afford to play hard to get. And as my business, like here, 5,000 RSP contribution, I'll take it. Tax free didn't exist back then. So I've taken anything anybody that was willing to trust me with their money, no matter how much, how small the account was. To me, if you had 1 million and you've given me 10,000, I managed it as if that's the only money you had. So I took care of it. And my wealthiest clients today, they started with me way back when with a small amount of money. And then I ended up earning everything, especially when they went through a 2007, 2008 market crash. You can say 2008. So they ended up consolidating and referring business and friends and family and so on. So I had to earn it, right? And I took care of it because I had to earn it. So I work hard to earn somebody's business and 10 times harder to keep it. Today, if I'm looking at demographics, I would say most of my clients fit a certain profile, 60 to 80 years of age. They're not looking for home runs. We focus a lot on tax and estate planning, retirement planning, cash flow, moving money from one generation to the other, setting up family trusts, holding companies, estate freezes, you name it. Like there isn't anything that I cannot do. Anything really, pension plans, benefit, like it's so that's part of also what pushed me to become better because I I got a lot of my designations, my licenses as I joined the business. So every year I had not only goals of let's say I want to achieve. I had educational goals that I want to complete. I want to get licensed for insurance. I want to get my CFP designation. I want to become portfolio manager. All these things, I just put a target and said I want to achieve them, and that's basically it. So before I knew it, I was more qualified than anybody I knew. Not that there's a ceiling to that, but between the people that I knew, I had these great designations, and that's something that's very important that I recommend to all advisors. If advisors are going to be watching this, would be um, look, getting to something called the fiduciary duty is very important, especially now. And any platform, like the regulators, they always come up with new rules, but these rules are always to protect the client. So don't, there's a reason why they're coming up with these rules. So just follow them. Don't try to push against them. So I'll give you an example. We went from commission-based industry where advisors made money by selling or buying securities to managed investments, to fee-based, to discretionary today. And that's a great platform because today when I'm trading a security, Chris, whether the client has $1, 1 million, 10 million, or 100 million, every single client gets the same price for every security. So if I'm buying Apple as an example, there's no preferential treatment for clients with more money than clients with less money. And that's called the fairness rule. Second, because I'm trading in bulks, imagine you're buying something from Costco, right? You don't need 10 toothpaste, but you get a better deal if you're buying it in bulk. So when we're trading securities, we often have, especially on the Canadian side, we have an impact on these securities. So it gives us the ability to make better decisions for our clients. Transparency, clients owning the securities, fiduciary duty, you name it. The list goes on and on. So
Mhm.
put your clients first, find the best way. Like, what does it take for you to become the best advisor? Understand the weaknesses that you have in your practice. So non-discretionary, it's time consuming. You write communication sheets. Every time you pick up the phone, I confirmed with, my client, Chris, to buy 10 shares of ABC at so on, confirmed, so on. So that's time consuming. So look at things that make your life a lot easier and then invest in the right people, invest in your team, get the
Mhm.
best people that are as hungry and driven to succeed and to help you succeed and grow your practice. People that are, they care about their job. And
Mhm.
that's basically it.
Awesome. Awesome. Wise words there, my friend Elie.
Thank you. Thank you.
So, what was your best way of finding clients when you started, and what's your best way of finding clients now?
the best way when I started, the best way is when, clients in general, they trust their accountants. So once you do a good job for your clients, the accountants, it's like a report card at the end of the day. They're assessing, okay, this you've done very well. You focus on, tax planning. What you're charging is reasonable. You didn't exaggerate. So it's a combination of many things, and you're delivering good results. You build that relationship with the account to make your client's life a lot easier. So you share the information, and then you get a chance to meet with the accountant. So um, the best clients that I've like the best way to get clients is always by referrals. So accountants used to refer me a lot of business. Right now, they just feel like unless somebody has X amount of money, they don't want to waste my time, even though I'm always grateful for the business. But I'm just saying that's how the accountants that I like, I'm in on a more friendly relationship with them. Um, but unless somebody has a lot of money, they wouldn't refer them to me. Today, where I get a lot of business, people reaching out, like if it's not referrals from existing clients, always the best way to get business is from existing happy clients. So I'd say, you know what, I'd like you, they complain to each other, they talk about business and so on. And then they refer them to me. And people reaching out online. Like I got a client from New Jersey. I have clients from different countries. People read about things that I put in place, and most of them, they're Canadian citizens that end up moving outside of the country. They have assets in Canada, right? So they want somebody that has the capability of consolidating and organizing their financial affairs. We get busy in this hamster wheel, working hard, paying off the bills, taking care of our families. We get to a certain point. What are we doing now? Like, what are we aiming at? And if you don't aim at anything specifically, you're going to hit it with perfect accuracy. So I create the financial infrastructure for them to say, okay, all my hard work, this is where I stand. And that's what if I keep on doing what I'm doing, that's how things will look like for me in 5, 10, 20 years from now. So I like seeing this. And my favorite part is when I actually do better than expected job and they come back to me after 5 years, say, Elie, this is the plan that you presented a few years ago. So, their wins become my wins. So, yeah, and I'm very hard on myself. So like if I'm not having a good year like last year, yeah, I'm upset. So I look for every possible way to make things better for clients.
Mhm.
Yeah.
Awesome.
I take things personal, even though you shouldn't. I take personal because I want the best for them. Right?
Yeah. It
Yeah.
it keeps that fire blazing underneath you.
Yes.
Yeah.
Yes.
Awesome. So the show is called the Ultra High Net Worth Clients Podcast. I'd be remiss if I didn't ask, how did you find your largest client?
Referrals.
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 How did you find your first large client? Maybe before the referrals were coming in. Maybe it was also
Wow.
referrals.
Actually, so a client that I cold called his mom. This is the first ultra high net worth. Okay.
Hmm.
A guy, I called his mom. That goes back to 2005. Cold call, 2005. He said, my son is out of town. I called the son. I said, please, I'd like to have a chat with him. With your permission, would you please give me his phone number? I reached out to him. I ended up earning the business after a few meetings. Then he referred family and friends. Then his accountant was so happy, became a client. Then the accountant referred me one of his clients who gave me 800,000 back in 2007. And then that client ended up consolidating everything else from an advisor that he was working with for more than 20 plus years. And that's just how things happen. You have to be out there. Like you can't this whole thing with advisors right now, working from home, not doing, the face to face. People want to, they like real estate. They like to see you. They want to see you dressed up. Don't pull that whole casual, I'm working from home advisor. It works if you're a designer. It works for like most professions. But you being an advisor, I don't know. Look, maybe I'm old school. I wear a suit. Only my family see me in jeans, like a handful of people. But I need to be at the office. I need to be sharp. I love being at the office, right? And this is how it pushes everybody else in the company. You have to lead by example. So I'm dressed up every single
Mhm.
day. I have my pins here, part of the company's logo. And yeah, every single day. And most of the time I'm like, I start early. But this is not the Wall Street waking up, hitting the gym at 5 a.m., I wake up, take care of my kids, drive them to school, or I work with the schedule with my wife, get to the office by 8:39. My workout is afterwards, after work and so on, but it's a full-time job. To be great at anything, you need to put above average effort. It's things that are going to happen because you just got lucky or you come from a wealthy family. Like it just doesn't happen. You have to earn it. So
Mhm.
ultra high net worth, and they see this, is a lot of the wealthy people, like I've seen it over the years. They say, you remind me of myself, because they
Mm.
hustle as well, no matter what business they're in. Like not one person, I'm going to say very few of clients that are ultra high net worth. So just for the people that are watching and this episode, ultra high net worth would be net worth of $30 million or more. Right. So it didn't happen overnight, but
Mhm.
sometimes, you know, clients took over a business from their parents that had established a business, that they took it to simply another level. So they have to get the credit, but there was a base. But most of my client base are people that just worked extremely hard and avoided mistakes, and they ended
Mhm.
up becoming wealthy over time.
Mhm. Awesome. Absolutely. So for ultra high net worth clients, that $30 million, that's a lot of assets to not already have someone managing. Do most of your ultra high net worth clients, do they already have a manager that they're just not happy with, or are they just like, I got shoe boxes full of this, what should we do?
No, I mean, most of them, they have actually good advisors,
Hmm.
but you have to be better, right? You're definitely not going to earn the whole business at first. 30 million, 40 million. They might start with 5 million, two and a half, 5, 7, 10, whatever it is. And then, you scale, you earn the rest penny by penny. Sometimes they have two, sometimes they have three. They diversify. But advisors, especially at large financial institutions, they haven't, let me keep this positive. They take the business sometimes for granted. It's not the name at the door that makes a difference. It's you're the person, you're the one who's managing their money. Right. So yeah, no, I need to be on top of my game 24/7. And
So
I am.
so what specifically does a ultra high net worth client notice about another financial advisor that they're like, I'm going to take a chance with this person, and then they slowly work over to them completely? Is there something there's just a new investment opportunity, new fund, new strategy? What have you noticed any commonalities there?
Most ultra high net worth, I'm going to say the majority of them, you can't earn the business because of tax or estate planning. They have the best tax lawyers in place. They've done an estate freeze. They have their family trusts and so on. I don't recall me seeing one client. I don't recall right now. Maybe I have, that just earned the business because I showed them this amazing tax strategy. They've had it, right? So these are people that they've been around for years and decades and so on. So earning the business is mainly, I'm going to say 50% because of my skills and 50% because the other advisor failed to recognize what the clients are looking for.
Mhm.
So it could be bad service. It could be didn't client manage the client's expectation properly. It could be anything, but a lot of any advisor that doesn't actually manage money and focuses on pushing products. This is, a product, a fund, a pool, or anything that sounds too exotic or the client doesn't understand it. Um, you're gonna have to explain yourself when things go bad. Because if I meet with them, there's a good chance, with full honesty and transparency, I'm gonna be going after the account. Right? But I never put the competition down. So I never say like this advisor did a bad job. I rarely even talk about the portfolio. I just focus on what I do, my track record, and if what I do fits what they're looking for or not. I almost, like I said, never have to put anybody down. Like today, it took
Mhm.
me maybe 20 minutes I'm supposed to present to somebody. And he said, okay, Elie, what are the next steps? I didn't have to talk about it. I said, let me present. He was like, it's okay. I trust you. I said, like, how? Like we're not there. So people know. people know, they've been around, they know who to trust, and like you just have to talk about what you have to offer them, and they'll be able to make a decision. If somebody needs more, I'm ready. I'm building my whole plan, tax estate plan, create reports, you name it. And
Mhm.
they need references, ask for it.
How do you get on the radar of an ultra high net worth client who already has a financial advisor?
I attended 5 events last week. Actually, one that I organized for my client base, where clients came also with their friends, many like high and ultra high net worth, most of them high net worth, some are, few of them were ultra high net worth. So they attended the event. It's not like the second day I picked up the phone and started calling them. So far, I haven't had a chance because I'm busy with everything else. And I know that people are going to start reaching out. So that was Tuesday. Wednesday, Thursday, Friday, Saturday, I attended 4 events. So I flew from Toronto to Montreal on Wednesday morning, and I have meetings throughout the day. At night, I sponsored brain. It's called Brilliant Night, which is it's for the McGill University neurology department for brain cancer. So I ended up meeting 5, 6 people, and so some of my clients at the event. I was thrilled to see them. Thursday there was Lise Wattier Gala. I met many wealthy people. Some of them, Pierre Carl Pilado, some of the wealthiest families. I met the ex-premier of Quebec and many wealthy business people. And executives in different firms. You have to be there. Thursday, there was something else. No, that was Thursday. Friday, Let's Bond for mental illness. Saturday was Chamber of Commerce. And I get people from the industry wanting to talk to me, or wealthy people. I'm talkative, as you realize. So it's just, but I'm not looking to close business. You know what I mean? Like,
Yeah.
or sign or get the account. We're just talking, and people like this, I guess, this honesty. So it starts with, complimenting guy for a nice jacket or lady for her dress or something. And then we hit it up. We start chatting for 5-10 minutes. That's
Mhm.
just how things start. So no, you have to give back. By the bottom line that I'm trying to say, you have to give back to the community. Wealthy people do give back to the community, but I don't just want to give back to maximize. Like, I don't do it with the intention to, like, I focus on causes that are important for me. So, sick kids, empowering women in business, mental health, things that are important for me, really. These are things that I focus. Like, I'm on the advisory committee for the University of Toronto Faculty of Music. I participate in that, other than the fact that the dean is my client. He just retired. And he's been my client since he was a dean from at McGill. Very smart guy, very knowledgeable. But I like what music does, to society in general. And I obviously I do my part by helping out. So that's basically it. You find common interests with people, and you make it happen. Tomorrow, on Thursday, I'm flying out to Montreal from Winnipeg this evening. On Thursday, I'm speaking at an event that's organized by an Israeli company. It's called DC Finance. And Israeli, I'm just highlighting because some of them had to go back home, but it caters to ultra high net worth. So people pay a fee to listen to few speakers. I'm one of these speakers. I've spoken at an event for them in Toronto and one in Vancouver a few months ago.
Mhm.
And it's not like something that you do once and you stop. People want to get comfortable with you. They want to ask questions and they approach you. So yeah, you have to be out there. And I write, about trust and money management, all kinds of things online. So people reach out online as well.
Mhm.
It's not a part-time job. Let's just say it's not a part-time job.
Yeah.
Yeah.
Wow. Well, from one podcaster, you should have your own podcast or YouTube channel. You are wildly entertaining and
Thank you.
wise,
Thank
my
you.
friend.
Thank
So
you.
we've definitely gone over, and I apologize for that. You were just
I apologize, Chris.
too
You don't have to.
interesting.
I have to apologize. I opened my heart here and I started talking for longer than expected.
And I could just keep asking you questions for the rest of the afternoon, but I will respect your time, and we'll wrap it up with one final question. It's an open-ended question. You can take it in any direction you like. The question is, what are you working towards?
Okay, it is an open-ended question. So look, I'm in Winnipeg today. This is something that I haven't been excited about anything as much as I have about this project, because I'm helping First Nations build the financial infrastructure for different communities. So that's something that I'm quite excited about, because, like I said, it's the effort that's focused, but will have an impact on tens of thousands of people at the same time. So that's something that it's going to take years and maybe the rest of my life to keep on help build it. And in the meantime, I'm growing my company advisor, looking to join somebody with, my leadership, what I have to offer them, the independence, the freedom, the tools to help them take their practice to another level. And I'm here to continue on doing this.
Awesome. And you're definitely going to do that. This was amazing and
Thank you.
super inspiring. Where can our audience find out more about you, Elie?
I have my own website, elienour.com. npw.ca would be the company's website. I'm on Instagram and LinkedIn. And they can reach out to me anytime.
Great. Yeah. It's in the show notes for the podcast and on YouTube. Elie, thank you so much for taking the time to talk to me and my audience
My
today.
pleasure.
This was fantastic. Super
Thank you for
enjoyed
your
it.
time, Chris. Thank
Yeah.
you.
Awesome. And to all our listeners out there, thanks so much for tuning in. Keep on growing out there, everybody. We'll see you later.